Hey investors, today we are taking a closer look at Chevron, one of the most established and resilient energy companies in the world. It's an integrated long-term energy business with strong upstream assets, stable demand for oil and gas outlook, and growing LNG exposure supporting durability. Large-scale integration creates resilience. It's not the lowest cost producer, but reliably positioned with strong reserves and diversified asset base and operations. It's highly disciplined, shareholder-focused management with clear incentives and consistent dividends and smart capital allocation. It's a Buffett-approved business management. Quality company trading at a slight premium, strong fundamentals, but a limited margin of safety. I would wait until valuation falls closer to a 10% required rate of return yield. So Chevron trades under the ticker CVX on the New York Stock Exchange. It's one of the largest players in the global energy sector. The company has a market value of around $317 billion, which places it among the top energy companies. Chevron is an integrated energy company, meaning it's involved in everything from exploration and production to refining, transportation, and marketing. The upstream segment, exploration and production, is its biggest profit driver. Global demand for oil and gas remains strong, as we will see a couple on the next slide, actually, despite the transition toward renewables, or stated transition, I would say. I would put it more as an addition. LNG, or liquefied natural gas, demand is growing as countries look for cleaner alternatives to coal, and Chevron is well positioned for long term. The company maintains strong reserves, and the Hess acquisition further boosts its future production. On the right, actually, you can see the charts highlight Chevron's reserves and resource replacement. So they show that the company is 1 year and 10-year reserves addition exceeded production. And they are set for future growth. Of course, on the 1 year, we'll still have to consolidate the Hess asset. So this is how they are thinking about the future. So global and oil and gas demand continues rising. So the chart on the left shows a steady growth in global and oil and gas demand over the next 30 years, over the past 30 years, and then going forward. Couple days ago, last week, the International Energy Agency stated they see oil demand growth until the 2050. So that's a big pivot from their peak oil idea. So demand is now at a record high, driven by population growth, industrialization, and transportation is basically. Even with renewable energy growth, I usually say it's an addition, oil and gas remains essential. Second, a significant supply gap is forming. So on the top right chart, which shows that existing supply naturally declines as wells deplete and assets deplete without ongoing investment. So by 2035, the gap between demand and supply could reach 50 million barrels per day, which is huge. According to the Chevron presentation, this highlights the critical need for continued development, especially from large, capable producers like Chevron. Gas demand remains really strong across all sectors. So on the bottom right chart, shows rising global gas consumption in power, generation industry, buildings, and other sectors. So natural gas is increasingly used as a transition fuel, replacing coal and supporting renewable intermittency. Of course, AI demand's going to drive this going forward, as we will see on a couple slides later. So first, strengthening core areas. So Chevron continues to deepen its acreage in core regions where they already have a strong infrastructure and expertise. Of course, they are globally well positioned, expanding also into new frontiers. The company is expanding its presence in exploration regions with high potential, but less existing development. So you can see them in Guyana. You'll see about the US-Venezuela conflict here. You see them present in Brazil. Of course, they are big in the new Argentinian region. So that's not an, how would I put it? Not an accident that the US is bailing out Argentina. They have a Permian-like asset in Argentina. And of course, there are more riskier regions. course, off the coast of Israel. You see in the East Mediterranean growth and development. Heavy investment also in data and imagining. Chevron invests heavily in advanced seismic imaging and proprietary data tech. This reduces uncertainty in drilling and drilling success rates, which would theoretically make their drilling and exploration more efficient. So the company uses AI-based subsurface tools that speed up geological characterization by around 50% according to them. Faster analysis means quicker decision making and lower exploration costs. Chevron has a long history of consistent dividend growth. As of 25, I think it's been the 38th year of their dividend growth. So the chart shows dividend per share rising steadily since 2014, even through oil price volatility. So it demonstrates basically the company's commitment returning to stable value. Chevron focuses on high return project and disciplined capital allocation. Strong capital efficiency helps them stay profitable even when oil prices fall. I'm not gonna show that actually in this presentation, but their capex is slightly below their depletion, DDA, basically depreciation and amortization rate, which implies no growth. Although that's not true, according to them, they are seeing substantial growth going forward. So Chevron maintains low debt, remains one of the lowest actually compared to peers, and compared to any company. They have a really strong balance sheet, providing them flexibility and protection against the cyclicality of the industry. Chevron operates also with industry-leading low break-even costs, around 40 bucks per barrel. My math is also something like that. We will see that when I'm trying to value the business. So lower break-even means the company can stay profitable at lower oil prices than competitors, although they are not the lowest cost producer by far. And of course, over the years, Chevron has maintained the steady share buybacks, adjusting with market conditions. Recent buybacks were around like 15 billion a year, and guidance for the future is 10 to 20 billion. So in the segment breakdown, you can see that upstream operations are by far Chevron's largest profit drivers. Total upstream earnings around just below 10 billion year to date in 25. US upstream contributed 4.6, while international $5.2 billion. This highlights Chevron's strong global production and footprint. Downstream earnings are significantly smaller. So downstream would include anything from refining, fuel distribution, and chemicals, bringing a combined of around 2.2 billion, breaking sort of evenly between US and international. The gap versus upstream reflects the more volatile and low margin nature of refining, basically. So Chevron's massive scale and low cost reserves, especially in the Permian, gives it a strong cost advantage to peers. The company vertical integration helps stabilize cash flow through all market cycles, right? So if you have lower oil prices, that can offset your refining costs and maybe help your margins, although that could be debatable. But there are these internal balancing acts if you have vertical integration. The company benefits from long-term supply partnerships and strong global brand, although differentiation is very much limited. Because oil is sort of oil. Of course, it's not that simple, but like any oil major, product differentiation is still limited due to the commodity nature of the industry. So Chevron leads peers in cash flow growth and production growth through 2026. Its break-even is below 50, as we discussed, 40 in the 40s, meaning Chevron can stay profitable even in lower oil environments. Although this is not cheap. So this is not a Norway type of oil play or the Middle East. Chevron consistently delivers higher cash margins per barrel than its major peers. This reflects its low-cost assets, strong operational efficiency, and disciplined project selection. Future projects, those spanning 25 to 2050, show much higher expected returns compared to competitors. This means Chevron can generate more value from the same dollar invested. The oil upside chart shows that Chevron benefits more than peers from a $10 increase in Brent, the higher sensitivity is a key advantage in rising commodity environment, as you can see on this top right chart. Although I would like to say that if you look at any major oil company, they will try to put together data that will say they are the best. So everything here you should take with a pinch of salt, which is Chevron derived presentation material. Still, Chevron is also a major natural gas producer across both the US and international markets. This diversified portfolio positions the company well for long-term demand growth, especially as gas plays a central role going forward for replacing coal, or gas is just really cheap in the US. You can also use it to produce electricity for AI data centers, but we'll see about that in a bit. So Chevron's portfolio includes assets with decades of remaining production, giving the company long runway for future output. So the chart shows strong resource depth across types. So like you have shale, you have deep water, you have LNG, and you have conventional assets. So it's not just let's say a shale producer. So it's not dependent on any single region or type. Yeah, let's take a look at Permian. So Chevron is the single largest mineral acreage owner in the Permian, covering both the Midland and Delaware basins. The map shows a massive, highly concentrated land position, including operated and non-operated and royalty acreage. Scale provides long-term, highly scalable value. So Chevron has delivered a 12% organic production in the Permian over the past 5 years, one of the strongest growth in the industry. And the production chart so they're 2020 through 25 reaching over 1 million barrels of oil equivalent per day. It was a major milestone. Superior returns compared to Basin peers is just an overall great asset for Chevron. Looking at management, Chevron's management has a strong track record of allocating capital efficiently, consistently prioritizing higher return project over volume-based growth. This discipline is one of the company's biggest strengths, especially if you think about the cyclicality of the industry. Management is also strongly aligned with shareholders' interests through dividends, buybacks, and performance-linked incentives. I suggest stopping the video and reading through all the KPIs. They are really business focused and no nonsense, basically. Chevron is known for running assets efficiently and safely overall, and of course they have a 38 consecutive years of dividend increase as of 25, placing Chevron among the most reliable dividend growers in the energy space. Of course, no wonder that Buffett bought the share, and it's a huge chunk of Berkshire's portfolio. All right, so this is from a recent interview with the CEO, I think on Bloomberg. Chevron is launching an off-grid power project to supply data centers. So decision driven by expected AI boom and the strain on grid-connected electricity. So facility will use natural gas turbines. Operational target is around 2027, similar to Chevron's existing remote operations. So if you want to circumvent the lacking electricity grid infrastructure, you can just put data centers next to where the gas is made and make gas turbine power plants there, and then you are set to go. So the West Texas strategy is basically project located in a Permian where Chevron has abundant low-cost gas, right? Because gas needs the infrastructure to get out, and then actually they can go even negative in price in those regions because you have just like a sea of natural gas. They cannot do much without infrastructure. So it's easier to build fiber fiber cables than pipelines. So it's easier to basically move data than molecules. So Chevron is increasing exploration spending, high potential in Guyana, Brazil, and Namibia, Gulf of Mexico or the US, and the Mediterranean, right? So this was still mentioned in the interview, and says the CEO said that the global political climate under Trump administration has opened many doors for new deals. So we'll see growth on that. Of course, the CEO as an oil company is a strong believer that energy demand will keep growing till 2050. He also mentioned what I just mentioned is the International Energy Agency's updated outlook. So Chevron expects strong free cash flow, resilient even at lower oil prices. And of course, oil price is likely to, he also mentioned what everybody kind of talks today about is that oil price is likely to face a downward pressure in 26 due to OPEC plus supply returning and some non-OPEC growth. LNG faces future oversupply maybe in the later 2020s and 2030s, but oil is more pressured near term, while LNG and natural gas just looks much better from a risk perspective. Okay, so Chevron plans to leverage its strong US gas position, given what we just discussed, over 3 billion cubic feet per day of natural gas production to support the growing needs of AI data centers, as the CEO just said. So this ties Chevron's core upstream strength directly into the fastest growing energy market. Long duration, capital efficient opportunity. So these projects are designed to deliver strong long-term cash flows using capital efficient development approaches. So basically you have a lot of gas and then you can, which are sometimes selling for like not even selling, they are like they have negative costs. You have to get the gas out. That's why you see sometimes gas just being burned, natural gas next to oil wells out of nowhere. So you can monetize something with AI and other energy generation related projects. That would be a huge bonanza for Chevron and others. So Chevron is already in an exclusive negotiation with potential customers for the final investment decision in 26, signaling strong progress. Development ramps up, as you can see in the chart, highlights how capacity scales over time from the first power in year 1, 2 to larger ramps up in 2, 3, and out of potential for after year 4. So consistent and robust free cash flow generation over the past years. Chevron has delivered a strong free cash flow with notable peaks in of course 2022 with the spike of oil. Reliable growing dividends remained a key focus for the company, and of course share buybacks. Although I would like to mention one key item here is that they didn't do the share buybacks in 21-2, but they sort of postponed them to 23-24, so they didn't buy it back when oil price was already high, pushing the stock sky high. So I generally dislike commodity companies buying back share when their stock price is already high. That's not smart because your underlying commodity goes up, stock price will follow. You have a lot of cash and you buy back something high. Let's just wait with the cash and buy it back later, or just pay dividends. And Chevron didn't buy back as many shares in 22 as others. So, and of course the balance sheet improved. Debt to equity ratio steadily declined. It's below 20%, so it's highly strong balance sheet. Chevron is targeting around a 6% annual production growth through 2026, which is huge. Quite strong for a major integrated oil company. This growth is supported by a 15 billion annual capex plus 2-3 billion structural cost reductions. Plus, do I see it? Now we will see it on the next chart. You also have to include, as you can see here in the small letters, our affiliate capex guidance is this. Okay, so it's basically going to be like 18-21 billion. On the next slide, we will see that if you include all affiliate partners. So higher returns and stronger cash generation by 26 is the target, with 12.5 billion in free cash flow. I'm happy because my models are lining up with all of what they're saying, so I hope I'm close. Basically, the slide brings together disciplined growth, rising returns, and strategic low carbon investments as an addition, which, as we saw at the beginning, is not really low carbon is not really so far doing much. It's mostly upstream. Okay, for next, we have to look at some of the guidance they provided. So Chevron is saying for the full year, it's gonna be around something here. Oil production, and you have to add up S for this. So keep in mind, this is what we're gonna use for projections, and For CapEx, they're saying 15 billion plus 2.5 billion, right? So that is basically what's gonna be our CapEx base and the production we're gonna use. Of course, in a couple of slides before, they said they're gonna, through 26, they're gonna increase it by 6% based on what's 25 is gonna look like outer years. All right, so looking at the valuation, we're gonna use the CapEx they said they're gonna do in the previous slide, so 15 billion plus the average of 2 and 2.5, so 17,250. Out, I calculated the break-even price, which is fitting what they said on the slide, so below 50 and above 40, based on the chart and the guidance. I use the same oil price for every oil company I look at, based on best estimates at the time. And the production, I used Chevron's guidance for Hess and itself, so together. Of course, I use a 10% rate of return. That's my hurdle rate. And for production, I use the guidance plus the 6% compound annual growth rate through 26. I think the company is worth around something like $98 if you want to get a 10% return. Profitability wise, it has nice return on equity. I would say not as nice return on investment, but we are talking about a commodity producer. Very low debt. And of course, you have to keep in mind, Chevron is not a low-cost producer. So it's not like an Equinor or an Aker BP or even a Petrobras. It's higher cost, but it has other, how would I put it? They have a really good balance sheet. They're a US premium company, so really high quality governance structure, historical structure. Of course, you have the US government at your back. So maybe it's not the lowest cost producer, but it has other advantages. Okay, their cost of debt is extremely low. Their coverage ratio is, there is no risk of bankruptcy whatsoever. So of course, let's put it 99% chance there is no bankruptcy ever. Pristine balance sheet, really cheap debt, low debt, and nicely profitable. You have today you get a dividend yield a bit about 4%, and their free cash flow yield in annualized 25 Q3 is just below 5%. So basically my margin of safety issue is only the valuation with this company. From risk, of course, you have oil and gas prices, and maybe we can add some geopolitical, given that they have assets around the world. So just to summarize, Chevron stands out as a high-quality, well-managed, integrated energy major with strong long-term fundamentals. Its scale, vertical integration, and disciplined capital allocation provides resilience even in a volatile commodity business. So it gets a green for meaning, right? Why not the lowest cost producer? Chevron's stable operations and strong balance sheet and shareholder-focused management make it one of the most reliable player in the sector. I would give a yellow for it because it's not a low-cost producer and its return on investment and equity could be better. Of course, you don't have, let's say, country risk. Like if you buy a Brazilian oil company or some other niche player, you probably get other types of risk. Yeah, so management is premium, right? We also mentioned Buffett invested for a reason. The only drawback, as said, is valuation. So shares trade at a premium to the free cash flow yield threshold I would like to see. A pullback would offer a far more attractive entry, but even today the company remains durable and seemingly a really good long-term investment. This is the commodity price assumptions I use. Of course, the further out you go, the less security it gets. And also, if you project cash flows, the more outer years you look at, the less meaningful the cash flow for your valuation because of the discounting. If you enjoyed this video, please like and subscribe and give me ideas what you would like to see. I'm thinking to make a couple videos about Canadian oil and gas companies. So I have 6 on the radar. So if nothing comes up, those will be in focus in the coming days and weeks. Thank you all. Have a good one and see you later. Cheers.